Good morning, everybody. Welcome to the latest edition of Morning Learnings. I'm delighted to be joined by Andrew Montlake, known as Monty, exceptional centre half. Don't know about being a Liverpool fan at the moment, and from Coreco Mortgage Brokers, the MD there. Andrew makes loads of regular appearances on BBC, Sky News, national and local radios, been in the industry since he was very young, February 1994, and also is the chairman of the Association of Mortgage Intermediaries. So thank you, Andrew. Appreciate your time this morning. So
thank you.
I read the papers. Well, I try not to actually. And all I read is constant negative news. So loads of fall throughs, mortgages are being pulled, interest rates are definitely going up. I'd agree with that one. House prices are going to drop by 35%. I mean, it's crazy out there. And if I was maybe looking to buy a property or looking to sell a property, I would be a little bit concerned with what I'm reading. So from an experienced person on the ground, what is really happening on there? What have you seen?
Well, it's really interesting. I think there was loads of doom mongering around, as there always is, especially around property and recession and interest rates hitting 6-7%. So I'm going to give you some good news, actually. There's a lot of reasons to be, I like this phrase, cautiously optimistic. And if you look at how January started, certainly it was bizarre. So January, we saw the most leads we've ever had in a month come in. Now, part of that is a bit of a bounce anyway that you get at the start of the year as people come off Christmas and think, that's it, I'm not spending another year in this house, or I'm not spending another year with you. So we saw a bit of that, but actually there are a couple of things that happened. One is we've seen that there is a demand of actually some real buyers, and especially actually first-time buyers, because what we've seen with mortgage rates is we've gone through the period where people were worried rates were going to hit 6, 7, 8%. That's not going to happen now, barring some other crazy political storm that we can't foresee. So actually, even though bank base rate went up last week to 4%, what we've actually seen is the cost of funds swap rates reduce again. So today is a good example. We've seen the first 5-year fix below 4% again, HSBC 3.96, 3.99. And that actually shows us that mortgage rates are actually coming down. So lenders haven't even got started on the competition that is going to fire them through this year. That everyone had a disastrous end to 2022. The last quarter was down. So they're actually going into this year with pipelines really low. So I think from now onwards, you're going to see a lot more competition with lenders. Mortgage rates start to come down, even though base rate might even rise again. But I think we're near the top of that. And actually, house prices probably have already dipped a bit. If you go back sort of October, November, December, and you saw the Halifax House Price Index today that said actually house prices have flatlined rather than fallen. So I don't think we're going to see this big fall in property values, maybe 3-5% over the year. And it's going to be very regional anyway. Some of our guys are already seeing sealed bids and competition in certain high demand areas. So actually, I think the year is a lot more optimistic than people think.
Good. That's really nice to hear. So again, was that the case that, I mean, how are you finding deposits as well? People having to save more money. What's happening there? And are you seeing that there's more gifted deposits coming from parents as a result?
Yeah, I mean, we've seen that for a while now. That's been a standard of the market for the last decade, really. Saving for a deposit is really hard. That is the hardest thing to do, especially in a cost of living crisis. But there are signs that that's starting to wane as well. If you fill up at the petrol, I filled up my car yesterday and it was 50p a gallon cheaper than it was like a few months ago. So actually stuff is starting to come down. But saving for a deposit is the age-old problem. It does become a bit of the haves versus the have-nots. If if you're lucky enough to have help from the bank of mum and dad, or even now the bank of gran and granddad, then you've got a bit of an advantage. And a lot of our clients who we see, especially in and around London, have help from parents. So that remains one of the big issues. But with house prices dipping a little bit, that helps.
Okay, so I mean, you gave last time we spoke, which I can't remember, maybe about 18 months or so ago, you gave some really helpful guides to buyers to be buyer ready. And if you'd be kind enough maybe to share that. So if I'm a buyer today, I'm a first time buyer, what will help me be better prepared if I come to see you? What do I need?
A couple of things, really. First of all is to check your credit score. So there are lots of credit reference agencies like Experian, Equifax, I think it's ClearScore, and basically have a check that your credit is okay. That's really important. There are little things you can do there. Make sure you're on the voters roll where you live, especially if you've moved around a few times. If you haven't got a credit card, then it can be a good idea to take out a credit card, use it sparingly. Make sure you set up a direct debit that clears it each month. But that gives, on your credit reference, that shows that you can borrow money, pay it back, borrow money, pay it back, and it actually builds up a good credit rating for you. Make sure your bank accounts are in order. So if you're doing things like online gambling, stop. Because underwriters don't like that kind of thing. If you've got any big expenses planned, maybe put those off for a while. If you're in your overdraft limit, that's fine as long as you're within limits. So just make sure that your bank statements look good over the last 3 to 6 months when you're going to get a property, and actually do a bit of research. I'd say, have a look online, have a look and do some research as to what mortgage rates are like, what you think you'll be getting, and actually that might help the conversation flow. But yeah, I think it's also start early at the moment. So if you do think you want to buy this year, it's actually a good idea to speak to a broker earlier rather than later. Don't wait until you found a property. As you know, if you're going to an estate agent and you haven't even thought about your mortgage, you're sort of at the bottom of the queue. If you're going to an estate agent, you've spoken to a broker, you've got an agreement in principle, you know that actually you're good to go, then that's what everyone likes to see, a serious buyer who is mortgage ready.
Okay, lovely. So you talked about the HSBC, the 5-year fixed rate under 4% now, 3.99. Are you finding, because again, one of the questions that I'm hearing from estate agents is a lot of people's 5 years, 2 years fix are coming to an end in the next, I don't know, 2 months, five months, whenever it is. Again, obviously, apart from advising them to come to Andrew Montlake at Coreco, what are people doing? What are people, are you hearing a lot of that? And what's the advice out there?
Yeah, so we are seeing a lot of it. I mean, I've actually got some. So if you've got a £300,000 loan and you've been paying 1.5%, and you're now faced with rates around about 4%, that's going up around about £400 a month on a repayment mortgage, or about £625 a month on an interest-only mortgage. So that's quite a big difference for a lot of people. Especially when you've got the cost of living as well, that's also gone up. So there are several things you can do. One is, of course, I'd say you don't have to come to me, but just get advice, because rather than just blindly pressing a button and staying with your existing lender, there are loads of different things you can do. So for example, and this is not normal advice, but for example, if you've got 15 years left on your mortgage, potentially you can extend it out again to 20 years or 25 years, depending on your age, and that will help reduce the payments. Potentially, if you're on a repayment mortgage, you can switch to a part repayment or part interest only mortgage. So again, you have to be aware that with the interest only part, you need to pay that back at some stage. But that could be a short-term gap. If you're lucky enough to have savings, then potentially you can take an offset mortgage, which your existing mortgage lender might not offer. And that will give you the opportunity, again, to use your savings in a tax efficient way to also reduce your mortgage payments. So there are various things that you can do to help mitigate the risk. And also, your existing lender might not have the best rates. So, especially at the moment, some of the product transfer rates with existing lenders, you can actually get a cheaper rate elsewhere. There's a whole range of different things you can do. So I'd definitely say speak to a broker early. Don't put your head in the sand on it. Don't worry about it. So that's basically what I do.
Okay, thank you. And just for I get a lot of people that are just starting in the industry and want to expand their knowledge and learn. Could you just be kind enough to go through what the fixed, variable, and tracker mortgages are to help them, please?
Yes. There you go. Right. So a fixed rate mortgage does exactly what it says on the tin. So if you're taking, and you can fix for say 2, 3, 5, 10, sometimes either 15 years plus. But if I take a 5-year fixed as an example, if you're fixing for 5 years at 4%, then you know that your monthly payments are always going to be the same each month for that 5-year period. So it doesn't matter what happens with Bank of England base rate, doesn't matter if it goes up massively or goes down, your payments are safe. They're always going to be the same. And fixed rates do come with some early repayment charges. So normally you can pay off 10% per annum without penalty, but anything more than that, then they would charge you a penalty to do so. So if you want to be safe, sleep well at night, know what your budget is, then a fixed rate's for you. Variable and tracker rates change. So if I take a tracker rate first, a tracker rate tracks simply the Bank of England base rate. So if bank base is 4% and you're on a tracker rate which is 1% above bank base, you're paying 5%. If the Bank of England base rate goes down to 3.5%, your mortgage the next month will go down by 0.5% and your payments will adjust accordingly. The risk is obviously that Bank of England base rate goes up and your payments go up. So one advantage that some trackers have is they have no early repayment charges. So actually it's a lot more flexible for people. And for those people who think actually we're at the top of the market, I don't think interest rates are going to go up any further, I can afford to take some level of risk and I need a bit more flexibility, then actually tracker rates can work well. A variable discounted rate works in the same concept as that, but instead of being linked to the Bank of England base rate, it's linked to the lender's variable rate. And the lender can change their variable rate whenever they want. So if they want to increase it, they'll increase it and your payments will go up. If they want to reduce it, they'll reduce it. What's interesting now is actually a lot of lenders' variable rates are quite high. So even though Bank of England base rate is going up, some of them haven't actually increased their variable rates. So you might be better off on a variable discounted rather than a tracker, but it really depends. So for all those kinds of things, I'd say there's no right or wrong. It all depends on your personal circumstances. And that's where any professional broker will be able to help and actually find out what your short-term goal is, what your medium-term and long-term goals are. So that's what's important to go through before you decide on just going for the cheapest rate, because cheapest ain't always best.
Okay, well, look, I'm really grateful for your time. It's nice that there are some people that are cautiously optimistic, which is great. So rather than all the doom and gloom that's out there, so it's nice to hear what's going on. And actually, it was nice to hear. I mean, just out of interest, how has February started lead-wise compared to January? Because I appreciate that bounce back, as you said. you seeing something similar, or is it quieting down the first week?
It was a little bit. It's a little bit down, if I'm honest. But actually, a lot of that was around the base rate announcement. So sometimes you find when there's a base rate announcement, it goes up. There's a little pause in activity. But speaking to a couple of our estate agency contacts yesterday, their lead flow themselves was back up. Come yesterday and today. So it's I'm still cautiously optimistic.
Good. Well, I like being people that are cautiously optimistic. So really grateful for your time. Thanks a lot. Appreciate it. If people want to get hold of you, Andrew, how do they do that, please?
They can do it on Twitter at Monty's blog, or on my LinkedIn page, or just go to www.coreco.co.uk and they can get hold of myself or any of our lovely down-to-earth friendly brokers there.
Brilliant. Thanks very much for your time. Really, really grateful. And
no worries. Thanks, Stephen.
Cheers. Bye.
Bye.